What is the difference between qualified dividends and ordinary dividends? In today's video, we are going to talk about this topic because it is going to affect how much you are going to be paying in taxes. Dividends are a form of income that shareholders, that people that have the stock, are receiving from the company. So we want to talk about the difference between qualified dividends and ordinary dividends because we want to pay the least amount in taxes, and it's going to make a difference if it is a qualified or an ordinary dividend. And it may not be so important if you are investing inside of an account that doesn't require you to pay taxes. But if you are investing inside of a taxable brokerage account, you are definitely going to pay taxes on the dividends you receive when you receive them. All right, let's first talk about what exactly is a dividend. Dividends are a portion of the company's money that they are paying out to shareholders. They are typically paid out in just cash, but they can be in the form of another share of their stock. Usually dividends are paid quarterly, but sometimes they can be paid semi-annually or annually. So essentially a dividend is money that a company is giving you because you are investing in that company. Not all companies pay dividends, so if you are looking for dividend payments in particular, make sure that the company you are investing in actually pays a dividend. And if you're wondering how to figure out if a company does pay a dividend, let's just take a quick look at an example. You can see here that I have just Googled Verizon and then put ticker after Verizon, and it pulls up with the stock price that Verizon is currently trading at. And then if you look toward the bottom, it shows a dividend yield. And Verizon's dividend yield right now is 6.81%, which is actually a pretty high dividend yield. And not just individual companies pay dividends. If you're investing inside of an index fund or even an ETF or a REIT, a real estate investment trust, those can also pay dividends too. You can do a little research, just quickly type in the company, and if they list a percentage by that dividend yield, then they offer a dividend. And let's take a look at just a list of different companies that offer dividends and what their dividend yields are, just to give you an idea. I just did a search for popular dividend companies. We can take a look here at these companies. So you can see Avalon Bay Communities, they pay a 3.5% dividend yield. It's over on that last column. And Consolidated Edison, they pay 3.52%. And Enterprise Products Partners pays 7.65%, so that one's a little higher. And then you've probably heard of Johnson & Johnson, they pay 2.57%. Intel pays 5.45%. And 3M pays 4.69%, Procter & Gamble 2.88%, and Realty Income 4.72%. So you can just get an idea, there's a lot of different stocks or companies that pay dividends. If there is a particular company you're looking at investing in, just do a search for them and see if they pay a dividend. All right, let's move to the next part, which is ordinary dividends. Ordinary dividends are generally paid out of a company's earnings and profits, and they will be taxed at the shareholder's tax rate, at the ordinary income tax rate. So if you hold one of these types of investments or one of these companies that pay ordinary dividends, you are going to pay your ordinary tax rate on those dividends that you receive. For example, this means if you receive $1,000 in dividends and your ordinary income tax rate is 22%, you are going to pay $220 on those dividends in taxes. To give you an example, REITs, real estate investment trusts, are often ordinary dividends. And now let's talk about part 3, which is qualified dividends. And qualified dividends are taxed at a lower rate than your ordinary income tax rate. So these are the types of dividends we want to be receiving. There are 2 parts in order to qualify as a qualified dividend. The dividends must meet certain criteria set by the IRS. It must be a U.S. company or a qualified foreign company. And the second part of that is that the shareholder needs to hold that stock for a certain period of time. So part of the dividend being qualified has to do with the company itself, which we don't have control over that part. But then the other part of it being qualified is how long we are holding that stock for, which is something we do have control over. If the stock paying those dividends meets both of those criteria, then they are going to have a qualified dividend. And the majority of US companies do have qualified dividends, but not all of them, so just be aware of that. And looking at index funds as well, some of those are going to be qualified and some may not. And the reason we want them to be qualified is because we pay that lower tax rate. We're going to pay what is called a long-term capital gains tax rate, which can be 0%, 15%, or 20% depending on your income level. And let's just quickly take a look at those rates so you can see exactly how much you would pay depending on how much income you are making. These are capital gains tax rates for the year 2023. If you are single and you have capital gains or dividends up to $44,625, you're going to pay 0% in federal income taxes for this particular investment. And then if you are making between $44,626 up to $492,300 per year, you're going to pay 15% in taxes. And then if you're making over $492,300, that's amazing, then you're going to pay 20% in federal taxes. And then if you are married, you can make up to $89,250 and pay that 0%. Or if you're making up to $553,850, then you'll pay that 15%. And then over $553,850, you'll pay 20%. It is pretty amazing that we can make up to about that $44,000 for single people and pay 0% on that income we are receiving from our dividends or our capital gains. And then I want to dive into a little bit more detail about how long you need to hold the stock for, and just bear with me because this is a little bit wordy, but I'm going to share an example with you afterward. This is from the IRS. They state to qualify for the lower tax rates, which we just saw, the taxpayer must now hold the dividend paying stock for at least 61 days during the 121-day period, beginning 60 days before the ex-dividend date, which is the first date that the buyer will not be entitled to receive that dividend. A stock bought on the last day before the ex-dividend date, which is the latest purchase date for collecting a dividend, for receiving a dividend, can still meet the holding period test for that dividend since there are 61 days left in the 121-day period. I know that was really wordy. Let's take a look at an example. So if we have this hypothetical situation in which you have dividends reported on your Form 1099 DIV, which will be sent to you, you will not have to worry about tracking these dividends. But if they are reported as qualified from shares in XYZ Fund, you purchased 10,000 shares of XYZ Fund on April 27th of the tax year, and then you sold only 2,000 of those shares on June 15th, but you continue to hold the remaining 8,000 shares. The ex-dividend date for XYZ Fund was May 2nd. Therefore, during that 121-day window, you held 2,000 shares for 49 days, which would be from April 28th through June 15th, and then you held 8,000 shares for at least 61 days from April 28th through July 1st. The dividend income from the 2,000 shares that you held for just 49 days would not be qualified dividend income, right? Because it doesn't meet that 61-day threshold. The dividend income from the 8,000 shares held at least 61 days should be qualified dividend income. So that is probably really confusing. But the thing is, if you are focused more on the long term, you don't have to worry about this because you're going to hold your stocks for at least that 61-day threshold that you need to, and you don't have to worry about the ex-dividend date or these other dates. You can just continue to invest your money, dollar cost average, just continue to invest in the stock market over time and just hold those for the long term. And that way, as long as that first piece of criteria is met, then you've met that second piece to make it a qualified dividend, which means you will pay less in taxes. And if you are looking to become a long-term investor and you want help investing in the stock market, I do have a free masterclass for you. I will leave a link below in the description. You can click on that and check out the free masterclass. As we can see, the tax implications of ordinary dividends versus qualified dividends is very different. The ordinary dividends are taxed at your ordinary income tax rate versus qualified dividends, which are taxed at that long-term capital gains tax rate. This means that the qualified dividends are more tax efficient, which means you get to keep more of your earnings. And like I said before, you don't have to track which dividends are going to be ordinary or which dividends are going to be qualified, because it will be done on the back end for you, and you will receive a form telling you which ones are qualified and which ones are ordinary, and then you can file your taxes accordingly or give that paperwork to your accountant and he or she can file your taxes for you. Comment below and tell me if you are going to invest in stocks or funds that pay dividends. And if you found this video helpful, please hit that like button and share it with someone else who would like to hear this information, and to the subscribe button to subscribe to my YouTube channel, and to the little bell to get notified on when I post new videos. And if you want to see even more content from me, make sure and check out the videos on the side of the screen. Thanks so much for watching. I'll see you in the next video.